Greetings, Happy New Year, and in particular, a belated Happy Hogmanay to all of our Scottish friends. Many of you will have watched our 1970s Redux documentary about the parallels between the investment climate today and that of half a century ago. In July 1974, esteemed financial journalist Sanford Rose wrote a famous article entitled "The Agony of the Federal Reserve" for Fortune magazine, in which he accused Fed Chairman Arthur Burns and the Federal Reserve of caving in to political pressure from President Nixon for loose monetary policy to improve his chances of re-election in the November 1972 election. Democrats in general regarded Burns as a Republican stooge. When his longtime economic advisor was appointed Fed chairman in 1970, Nixon announced, "I respect his independence. However, I hope independently he will conclude that my views are the ones that should be followed." Historical accounts suggest that Nixon constantly pressurized Burns throughout 1971, even leaking a fictitious story that Burns had asked for a $20,000 pay rise at the same time as he was pleading with the public for pay restraint and price controls. It is a historic fact that in the second half of 1971, Burns cut the Fed funds rate from 5.5% to 3.5%, even though CPI inflation was still running between 3 and 4%. The word went out that 1972, by God, was going to be a very good year, confessed one Treasury official. US GDP growth accelerated from 3% in 1971 to 5% in 1972, and Nixon was re-elected on a landslide, only to see inflation re-accelerate and hit a new high of 13% in 1974. Now, although Burns stated that there was not one shred of truth in the article and actually raised the Fed funds rate back to 5.5% at the beginning of the 1972 election year, the US stopped convertibility of its currency into gold in 1971 and came off the gold standard completely in 1973, whilst in 1974 there was the first OPEC oil embargo. The story of Burns stimulating the economy for Nixon has since become folklore of monetary policy becoming subservient to political expediency. Now, ironically, Fed Chairman Powell has regularly warned about the dangers of repeating the mistakes of his predecessors in the 1970s. At the Jackson Hole Symposium event in August 2022, just 16 months ago, Powell specifically said, "Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy." Now, following December's FOMC, the rates market is now expecting a similar reduction in rates from Powell this year, also a presidential election year, even though inflation is still running above 3% when the Fed's target is 2%. We wonder how kindly history will view Jerome Powell's dovish December pivot. Could he now be haunted by the ghost of Arthur Burns? The main event in December was undoubtedly the FOMC press conference, where Fed Chairman Powell gave an extraordinarily dovish performance. Gone were the previous warnings of higher for longer interest rates. There was no more talk around vigilance on inflation. Powell said that the Federal Reserve would not wait for inflation to get back to its 2% target before cutting the overnight Fed funds rate. He also appeared to suggest that the Fed had been correct in its initial diagnosis that inflation was transitory, a word which he subsequently retired in his congressional testimony in November 2021. Powell appeared to endorse the market view that the battle against inflation had been won without a need for an economic recession. This central bank victory lap was greeted with euphoria in both bond and equity markets. For bond investors, future interest rates could go lower if the battle against inflation had indeed been won. For equity investors, not only because lower interest rates justify higher valuations, but also because if an economic recession can be avoided, corporate profits should remain at least resilient overall and perhaps accelerate. The consequences of this are that, now encouraged by the FOMC, US interest rate futures are now factoring in 725 basis point interest rate cuts this year, beginning in March. Back on October the 19th, the 10-year benchmark US Treasury bond briefly touched 5% for the first time in 2007, but it subsequently fell all the way back to just 3.87% at year-end. Monetary stimulus has already been front-end loaded by the loosening of financial conditions that has taken place in response to Powell's rhetoric at the FOMC. This means, ironically, it is now less likely that these cuts to the Fed funds rates are actually delivered because economic growth will surprise positively. Let us also remember the following points. Whilst Q3 real GDP growth was revised back to 4.9% or 8.4% nominal, Q4 GDP, as estimated by the Atlanta Fed nowcast, has seen steadily upwards revisions from just over 1% in October and is now running at plus 2.5%. With the same institution forecasting Q4 PCE inflation of plus 2.9%, if correct, Q4 will still see nominal GDP growth of 5%. The US economy currently has full employment, with wages increasing by 5.2%, which is down from 6.8% in the summer of 2022, but is still double the average of the last decade. This is a no-landing economy, not one that currently needs stimulus. The Fed's inflation target is 2%. Headline CPI has fallen from a peak of 9% in June 2002 to 3% in June 2023, but has since been very sticky and is currently 3.1%. Core CPI, excluding food and energy, is still 4%, whilst the Fed's favorite measure of inflation, PCE, is currently 3.2%. Although the money supply has been contracting, it is now contracting at a less fast pace and may start growing again. US federal deficit spending is still estimated to be at least 7% during the fiscal year to September 2024, which, aside from the previous year's absurd 8%, would still represent the biggest fiscal stimulus ever outside of world wars, the Great Financial Crisis, and COVID lockdowns. So if the US economy is already growing at a nominal pace of 5% in Q4 last year, but is now going to be subject to significant monetary stimulus, as well as unprecedented peacetime fiscal stimulus at a time of full employment, then is likely to avoid a recession, and not only avoid a recession, but see accelerated economic growth into 2024. Whilst this absence of recession and possible re-acceleration should lend support to more cyclical and commodity areas of the market, it seems likely to me that duration, on which recent surveys have shown record bullishness, sells off again. But what could explain Chairman Powell now throwing caution to the wind? Has he seen weaker economic data ahead, or are there political motivations? With headline inflation still well above the 2% target, the US economy is still subject to unprecedented fiscal stimulus. But with President Biden still trailing in the polls and getting no credit for the strong economy, is it conceivable that Powell was subject to political pressure either from the Treasury or the Democratic appointees on the FOMC to change course to avoid the obvious calumny in the eyes of polite society of the re-election of Donald Trump? Watching the FOMC press conference open-mouthed, a preposterous suggestion occurred to me that old hawkish Powell might have been discreetly displaced by a new dovish, democratically determined doppelganger. Or had the real Jerome Powell, in fact, committed Arthur Burns' original sin of prematurely loosening monetary policy, only to see inflation rebound and hit new highs over the next few years, as it did in the 1970s? The agony of the Federal Reserve. Only time will tell. The aim of the fund is to deliver double-digit annual returns, which are uncorrelated to the market and therefore most other funds. Over 2023, the fund returned 14.6%. This compares to the absolute return sector, which returned 4.4%, so third out of 85 funds, and the Lipper long-short equity Europe sector, which returned 4.3%, so third out of 67 funds. The fund had roughly the same volatility as the European stock market, to which it had zero correlation. Now, during 2023 as a whole, our average long position gave a return on invested capital of 12%, so an 11% total contribution to return with an average gross exposure of 94%. Our best performing longs of 2023 were Builders First Choice, which was up 134%, product tanker outfit Hafnia, which was up 54%, Amazon up 61%, and Uber up 67%. The year, our average short position delivered a return on invested capital of 8%. With an average gross exposure of 46%, this was a 3.6% total contribution to return. Our best performing shorts were all bus banks, Silicon Valley, Signature, and First Republic Bank, which we made 99% on, all of which went bust. We also had winning shorts across a range of other industries, Hexatronic in telecoms down 81%, Farfetch, an internet luxury goods retailer, down 71%, and Auron, a utilities company, down 65%. Given the strong market return of the year of 15%, including dividends, we can conclude that although our longs contributed more to returns, our long alpha was somewhat dull at -3%, particularly in Europe, whilst our short alpha was exceptional at +23%, even if this contribution to return was more modest, leading to a very positive combined stock picking alpha of 20%. The value of short selling is more easily identifiable in periods of market weakness. There were 5 negative market months in 2023, during which European stock markets delivered a negative return of 11%. In those same months, the fund delivered a positive return of +24%, what we term a negative downside capture ratio for the fund relative to the market movement of -223%, which is a very positive statistic. The fund has now delivered 5 calendar years in a row of double-digit positive returns, which to our knowledge is a unique feat amongst 3,500 regulated investment funds in the UK industry. During these 5 years, the fund has delivered a cumulatively positive return of +88%. This compares to the total return, including dividends from the FTSE, of +39%, of MSCI Europe of +60%, and MSCI World of +81%, from US Treasuries of +3%, and from UK government gilts of -13%. Like every other equity fund we can think of, we've beaten stock markets with zero market beta or benefit from being correlated to rising markets. In fact, we've made more than 100% of our return in falling rather than rising markets. It is extremely rare for a fund to have beaten a 5-year equity bull market, but at the same time have gained no benefit from the bull market. Over the last 5 years, 40% of months have seen negative stock market returns, during which we have delivered +109% versus the market return of -59%. Just think how returns would compare without the tailwind of rising markets, which has floated less seaworthy boats. There is, of course, room for improvement. We have made much more money in our long book by virtue of generally rising markets 60% of the time, but our long alpha has overall been modest. Given I have previously generated significant long alpha in different market conditions, I think this is more of a reflection of the strong bias towards growth stocks over the last 5 years, to which we are not ideologically opposed. Nevertheless, our long alpha always seems to come easier to us when value is back in vogue. By contrast, the significant short alpha generated doesn't seem to have any correlation to growth or value styles. Generating positive returns over the last 5 years from shorting, when including dividends, the market is up 60%, has been remarkable and unusual. In long-short investing, you get 2 bites of the cherry, meaning that our double alpha over 5 years has been more than 100%. It is often said that Argonauts is a more volatile absolute return fund. If that is our main crime against a sector that on average has delivered just 14% with an annual volatility of just 4%, then we plead guilty as charged. We are not a go-nowhere fund, but our volatility on average has been lower than the main global stock markets. If you want lower volatility with low returns, I suggest you invest in cash. We have never claimed to be a low volatility fund. We are something better, something far more valuable. We are a low correlation fund. We have no correlation to equities, bonds, growth, or value. We have delivered at different times. That is what makes us a valuable and unique investment prospect. Investors using Argonaut in their portfolio have generated higher returns with lower volatility. This is the only free lunch in investing. We believe that a hedge fund should offer not only compelling returns, but returns that come at different times to commoditize market beta, which will always be more easily manufactured and can therefore be bought more cheaply through the passive fund management industry. The future of active management, we believe, is not more beta, but more alpha, in fact, double alpha from long and short books. We would also note that our fund returns are always quoted after all costs. You wouldn't automatically assume that a cheap suit or a budget airline offers better value. So why not apply the same principle to investing? We have no hidden costs. Look at our returns and when we generate them, and then decide whether we represent good value. Whilst the future is guaranteed to be challenging, this demonstrates that there is value in seeking diversification in Argonaut's active management. We remain grateful to our unit holders for their continued support. 2024 is likely to be surprisingly positive for the economy, but not necessarily good for the stock market. It may resemble more like 2022 than 2023. We also see high geopolitical risk with concerns in 3 theatres: Ukraine, Middle East, and Taiwan. We are well hedged against this with long positions in shipping and defence. There is also the scope for civil conflict in Western democracies, a risk which is small but underappreciated in financial markets. We see bonds and equities as likely to stay highly correlated, meaning that investors will struggle to find assets offering attractive diversification. Perhaps we can help. We are aware that it takes a long time to build a successful investment reputation, but they can be more easily lost. It happened to me once before, but I remain focused on maintaining and improving my track record. We are currently running modest gross exposure and will continue to focus on generating unique double-digit uncorrelated returns, which are difficult to replicate and blend well with other funds, whether passive or active, that are more exposed to market directions.